Now speaking, Matt Gunter, Investor Relations. SelectQuote held their fiscal third quarter earnings call on March 31, 2023. On the call were Chief Executive Officer Tim Danker and Chief Financial Officer Ryan Clement. A replay of the call is available on their website along with a slide presentation. Non-GAAP financial measures were discussed and can be found in the earnings release and investor presentation on their website. Certain statements made may be forward-looking statements. This call involved risks and uncertainties which are outlined in their Form 10-K, 10-Q, and SEC filings. Now speaking, Tim Danker, Chief Executive Officer. On the left side of the page, we detail our customer risk score, which is a leading indicator of customer and policy risk. The improvement to this metric has been significant since EAP 2021. We believe it reflects the effectiveness of our marketing and sales practices, as well as improved underwriting processes. In the middle of the page, you'll see the 90-day active customer rate for new policies originated in EAP 2021 and OEP 2022. This metric has steadily improved over the past 3 quarters. And we are now approaching the low 80s in terms of percentage of customers still active after 3 months. The most important point here is that these trends have occurred despite increasing competition in the Medicare Advantage space. Lastly, on the right side of the page, we review our policy approval rate, which is the total number of approved policies divided by the total number of applications received. This metric has improved 450 basis points year over year and remains above 90% this quarter. The quality of the leads we receive is higher than ever before, and combined with our ability to convert those leads into policies, our new business performance is firing on all cylinders. We feel very confident in our ability to continue to drive returns from these key metrics going forward. SelectQuote delivered strong third quarter results better than internal forecasts, driving consistent improvement over the past 5 quarters. The company is well positioned to produce more predictable, profitable, and cash accretive growth in the future. For the quarter, SelectQuote generated 166,000 mAh policies at an LTV of $965, up 3% from last quarter. Operating costs per approved policy decreased 12% year-over-year and 29% on a trailing 12-month basis, while marketing expense per policy improved 17% year-over-year and 36% on an LTM basis. Agent close rates were approximately 28% higher year-over-year on an LTM basis. Healthcare services revenue more than tripled year-over-year to $71 million, and SelectQuote is now ahead of schedule in its goal to drive positive cash EBITDA for fiscal 2023. Full-year fiscal 2023 guidance ranges to $950 million to $970 million in revenue and $40 million to $50 million in adjusted EBITDA at the respective midpoints. Leading indicators such as customer risk scoring algorithm and lagging indicators such as policy approval rates and 90-day active customer rates have improved meaningfully since implementing strategic redesign last fourth quarter. Our data science team developed segmentation and consumer targeting efforts to analyze dozens of qualitative and quantitative factors. This resulted in a 19% decrease of high transactional categories and a 70% decrease of very high transactional categories year-to-date compared to fiscal 2022. Additionally, there was a 70% increase in tenured agents during the 2022 EAP season. As a result, approval rates increased by 450 basis points and 90-day active rates increased by 875 basis points since the start of our redesign efforts. In February, Ryan Clement was appointed CFO of SelectQuote. Now speaking, Ryan Clement, Chief Financial Officer. SelectQuote had a strong quarter, with revenue growing 9% to $299 million, the third highest revenue quarter in company history. The senior division delivered a 32% adjusted EBITDA margin, which was roughly on par with its historic peak profitability. Healthcare services had 45,000 active members, up 14% sequentially and 165% year-over-year, and revenue of $71 million, up 30% sequentially and double the rate of member growth year-over-year. The life and auto and home segments drove $8 million of adjusted EBITDA, compared to a $2 million drag a year ago. Cash efficiency has improved significantly over the past year, with $80 million of adjusted EBITDA and $97 million of cash EBITDA year-to-date. For fiscal 2023, SelectQuote updated its guidance ranges to $950 million to $970 million of revenue, $68 million to $48 million of net loss, and $40 million to $50 million of adjusted EBITDA. Credit Suisse analyst Jonathan Yong inquired, "Have you seen an impact from the new CMS marketing rule? How do you think it will affect you and your carriers in the long run?" Tim Denker replied, Jonathan and I had a call this morning where we discussed a high-quality question. We both agreed that we are 100% in line with CMS' goal to improve the beneficiary experience and transparency. We have been in the business for a long time and are well prepared for changes in regulation. Our focus is ensuring that seniors can access MA with ease and that there is transparency and choice for them. We will continue to work closely with Chief Operating Officer Bill Grant replied, we have been able to effectively navigate regulatory changes since the initial drafts of the rules. Credit Suisse analyst Jonathan Yong inquired, this question is asking about the WellCare Preferred Distribution Partner Program. It seeks to understand what this means for the person asking the question and how it is different from their prior relationship. Tim Denker replied, overall, our model was validated by the managed care organizations for its quality, proving that our combination of quality and scale is critical to the industry's ecosystem. President, Senior Segment Bob Grant replied, partnering with WellCare, Centene improved our 90-day persistency. We believe our investment in creating a seamless customer experience will make material strides to improve 90-day persistency with carriers who have struggled in the past. Citi analyst Daniel Grosslight inquired, have there been any material changes in the percent of revenue that Centene represents since the last 10K, 19% in 2020? Given the advance rate notice and some headwinds, how is MA growth for 2024 being thought about in general, and what is the impact of Centene's announced slowdown in growth for 2024? Tim Denker replied, over the last 5 quarters, we have made changes to strengthen our foundation across all major elements of the business. We are focused on improvements in unit margins and profitability over growth, however, there is still potential for growth. We will provide more information about our growth trajectory in August. President, Senior Segment Bob Grant replied, we have seen Centene's decision to invest in us, despite the general market slowdown, as an indication of their focus on quality growth and customer experience. Citi analyst Daniel Grosslight inquired, can you give us an estimate of the percent of core versus flex agents you are expecting for the full year of 2024 and any metrics related to their close rates or productivity differences? Ryan Clement replied, our core agents are 1.52x more productive than our flex agents this past year. We implemented a new hiring and onboarding strategy which has resulted in flex agents performing closer to the core agents. Our strategies have been successful as seen in Q4, so we plan to continue executing them. Citi analyst Daniel Grosslight inquired, can you provide the breakdown of core and flex spending for the current fiscal year and your projections for next fiscal year? Ryan Clement replied, we are not providing guidance for FY24, but we achieved a 70% success rate in the core category during our most recent EAP season, which is significantly higher than the previous years. We will have more details to share. Tim Denker replied, I have been managing the business this year with a more consistent agent force, compared to the peaks and valleys we had in previous years. This strategy appears to be working, and we plan to keep this approach going forward. RBC Capital Markets analyst Ben Hendricks inquired, have I seen any changes to the platform, from a consumer perspective, as a result of the work you've done with carriers ahead of the CMS rule and changes made to ensure compliance? Chief Operating Officer Bill Grant replied, we have been able to confirm that the consumer engagement process with CMS will remain largely unchanged. RBC Capital Markets analyst Ben Hendricks inquired, can you provide us with an understanding of how fixed and variable costs have progressed, and how we should model them going forward based on your new guidance? Ryan Clement replied, yeah. So, for May inquired, Tim Denker replied, I have seen great improvements in marketing and cost management, which has led to efficiencies that can be seen in the bottom line. Our agents are performing extremely well with low attrition rates. We are continuing to work on LTVs and have seen 2 consecutive quarters of over 30% margins in our senior business, which is expected to continue. Ryan Clement replied, we have taken a $40 million expense cut since last year and have been disciplined with investments, particularly in our SelectRx and healthcare services platform. We anticipate the business will break even by the end of the year, due to strong marginal unit profitability for each customer we acquire. We remain focused on expense. Tim Denker replied, we are proud to have achieved great success in the past 5 quarters and to have built a strong, durable operation. We are confident in our ability to capitalize on the large healthcare opportunity for American seniors. We look forward to speaking with you at the end of summer to share our outlook for fiscal 24.